Chapter 5 is dealing with when we have inventory. So when we have inventory, we deal with different accounts, and we're going to talk about that. So basically, in dealing with merchandising, such as Macy's, we deal with purchasing inventory for resale, and then when someone purchases the inventory, we need to take into account the sale on that inventory along with what was sold, what inventory was sold. So when we're dealing with merchandising, there are two methods that we can use to keep track of our inventory. We're going to talk about that today: periodic and perpetual. A perpetual method is when, after every sale, your inventory gets updated. Periodic means you do nothing till the end of the year, and you account for what was sold or lost by a physical count. With a perpetual, you still do have a physical count at year end, but you always know where you stand with inventory.
So perpetual on what? Sorry?
Periodic. Then, when we record merchandise purchases, we're going to talk about how freight is included in the costs of merchandise. We're going to talk about when purchases get returned, what kind of accounts we use. When we have discounts for purchases, usually when companies pay within a certain period of time, you're given a discount, how we account for that. Then we're going to talk about when we sell goods, how we handle sales, returns, and allowances. People buy something, then they return it. How do we handle that? We'll also deal with something called sales discounts. Based on when they pay, they may get a discount. Then from there, we're going to talk about a new type of income statement because we've got some new items here. We're going to have a cost of goods sold and a gross profit. So we're going to talk about that, and then from there, look at some ratios, gross profit rate and profit margin, to understand really how much they're making on particular sales of inventory. So, we all know of various merchandising companies. Walmart, Amazon, Macy's, you name it. They don't make their own products, but they purchase inventory for sale. Okay? 3M is more of a manufacturing company. Toyota is more manufacturing. We're dealing with merchandising where they purchase the goods for resale. Okay? So, when we deal with the merchandising industry, we are going to have sales revenue. The sales revenue is what we purchased the product for. So let's take, what's the big sports place down in Burnsville?
Dick's.
Dick's.
Sports Authority?
No. No. Gander. Gander Mountain. Gander Mountain, you purchase, we go in and we purchase a gun. So sales revenue is the cost or the price we pay for that gun. Now, Gander has to take into account what they purchased that gun for. That's cost of goods sold. So when we buy a gun for $1,000, they need to take into account what did they actually purchase that gun for. Say it was $700. That would be cost of goods sold. The cost of the good they sold. Then from there, our sales revenue of $1,000 less the cost of goods sold, $700, equals what's called gross profit, the $300. Now, we don't have cost of goods sold and gross profit when we're dealing with a service industry. We don't have anything we're selling product-wise. We just are selling a service. Then after we determine our gross profit, Then we're going to, as normal, take our operating expenses, which end up equaling net income. So the new piece in this chapter is dealing with cost of goods sold and the gross profit. Now, when we're dealing with a merchandising business, the operating cycle is going to be longer than that of a service industry. Why? There's extra steps in this process. With an merchandising inventory, you get cash. You need to go buy inventory. You receive the inventory, then you put that inventory out on your shelves to sell it. You receive the cash, and you start all over again. When we're dealing with a service industry, we get cash, we perform services, we get the money, we do it over again. So there's an extra step in merchandising which makes it a little longer cycle. So when we deal with the type of inventory method we use, perpetual or periodic, basically this isn't dealing with which products we're really selling. It has to deal with the cost flow, how we account for the money piece, the money aspect. When we deal with this, we start with a beginning inventory. We buy inventory. So we start with a beginning inventory, we purchase inventory, and our beginning inventory plus those items we purchase gives us all the goods we can sell. Then we end up with, out of those goods we can sell, some get sold, which is cost of goods, and the rest end up in ending inventory. So the flow is basically the beginning inventory, let's say, is $1,000. Purchases, let's say, are $8. And that will be inventory available, which would be 9. Then we count our ending inventory. If our ending inventory is sitting at 3, that means we sold 6. What I'm trying to show you here is the formula you can use to determine any of those aspects. So if they give us cost of goods sold and ending inventory, and we have our beginning inventory, we can figure the purchases. As long as you know this formula, you could figure out any of the missing pieces here if they give you the others. Am I making sense? So if you have your ending inventory and your cost of goods sold, then you know the amount of inventory that was available. See, because that's everything. If they give you your beginning inventory, you'll be able to put in your purchases because you can back into any of these variables based on knowing the others and understanding the flow of how it works. Am I confusing you? We'll go over problems like this. Put that hat on. I'm joking. You know I am so joking. Put that hat back on. Yeah.
So, we're not talking about profit yet or anything now.
Nothing.
This is just inventory and the changes.
We're just trying to understand the inventory starts with a beginning amount. Always starts with a beginning amount. Throughout the year, we purchase inventory. And then we end up with all of that's available for sale. If they give us our cost of goods sold, we can determine what our ending inventory is. But if they give us our ending inventory, we can determine what our cost of goods sold are, because it all has to balance. So, perpetual system is where detailed records stay maintained on every purchase and every sale. They show inventory that should be on hand for every item. Menards, I hate it because they're not always accurate, but they have a perpetual inventory. Most stores do nowadays have perpetual inventory because of our great computers. Companies determine the cost of goods sold each time a sale occurs. Now, please note though, in the end, at the end of the year, they still will do a physical count. Why? Hands have the ability to allow inventory to disappear. Sometimes there's inventory that's broken or becomes, it's not worthwhile. So there will need to be adjustments to the perpetual system versus what they actually have on hand. Make sense? We go to Menards, and my husband wants to buy so many big posts. They say, oh, there are 20 out there. Well, my husband pulls them up, and when some of them are like this, for him, that's not a viable purchase. So at the end of the period, they've got to determine, even though they show that as inventory, it's not going to sell at full price. Maybe someone will buy it, but not when you're putting fencing in the ground. You know what I'm saying? So basically, perpetual is a computer updated system that always keeps track of where you are after every sale. The periodic system, they don't keep detailed records all the time. They keep a track of all the purchases throughout the year, beginning inventory, but it's not until the end of the year that they really calculate their cost of goods sold. So they keep track of it all, and just like I did here, they keep track of their beginning inventory plus all their purchases. They count their ending inventory. That's the only way they know what was sold. Pretty poor system. What are the advantages of a perpetual? Shows the quantity and cost of the inventory that should be on hand at any time. Now, a perpetual system really is needed when you've got big buck items, to keep track of them. It ultimately provides better control over inventories than a periodic system. You always know what's on hand. Under the I already said that. So, how do we record this? When you're using cash or you're using credit, we record the transaction when we receive the goods from the seller. When title passes, know that for this next chapter. When are goods shown in inventory? Some of the questions are like when they're in your when you paid for them, when they're in your warehouse. It's, guys, the real answer is when title passes. We could have items that are in our warehouse that aren't ours. They could be on consignment. We could have products that we don't necessarily have in our inventory, but because title passed when the seller put them on the FedEx van, we received them. We have title to them. So no, they're saying normally record when goods are received from the seller, but we're going to talk about what that means, okay? Purchase invoice should support each credit purchase. So I'm getting ahead of myself. So let's just talk about this. When we receive the invoice or the bill from the seller, it should show us exactly what we purchased, the amount, and the cost we purchased it for. So here's an example. Sock Stereo, who's the buyer, uses as a purchase invoice the sales invoice prepared by PW Audio Supply, the seller. We're going to prepare the journal entry for Sock Stereo for the invoice from PW Audio. So basically, SOC purchased